Listen, they gave me 30 minutes to tell you everything I know about the situation. That's 29 minutes too long. Because nobody has a clue. We all make it up as we go, you know that. If the real and ultimate measure of intelligence is what you do when you don't know what to do, then the next few weeks, months, and quarters will test the economic IQ of the Bank of Canada, because they are the first to admit that they are as confused as we are. I must share a quick story with you just to illustrate this confusion. It was not too long ago. I was in Saskatoon. It was a long day full of many boring meetings. In the evening, I took a flight back home to Toronto. I had three options what to do in my flight. One was to read my book. The other was to watch a movie. The third option was to calculate the output elasticity of the manufacturing sector to changes in interest rates. So after 10 minutes of the back of the envelope calculations, I came up with the number. The number was 0.9, fine. And then a day after, I went to my office, put it in my newsletter, sent it to clients, and forgot about it. 2 weeks after, I had a meeting with the Bank of Canada. And I meet with the Bank of Canada very often, unfortunately. No, really, they believe in what they call constructive ambiguity. You know, you ask them for the telephone number, they give you an estimate. Believe me, it's a pain. And one item on this agenda, to my surprise, was this output elasticity. And to my greater surprise, their number was 0.9, my number. I must tell you, I was very impressed. Well, after all, they have an army of PhDs. I was doing it being jet lag from Saskatoon. We got the exact same number. So after 20 minutes, I couldn't resist anymore, and I said, can you tell me what kind of assumptions you used to come up with this number? And they said, actually, we used your number. What I'm telling you here is that the blind leads the blind. Nobody has a clue. We all make it up as we go. So given this environment, we have to make sure that we understand where we are. Just the other day, I had a lunch meeting with some clients. So on the way to the lunch, the elevator, they asked me, do you have good news for us? And I said, well, depends what they serve for lunch. And then I was thinking about it. What is good news? If I tell you that tomorrow the economy will generate 200,000 new jobs, very strong. If I tell you that tomorrow the economy will expand by 4%, very strong, is it good news or bad news? Well, it sounds wonderful, but for the Bank of Canada, it's a nightmare, because it means that they are losing the fight against inflation, then they have to stop cutting interest rates. So in a very twisted way, and that's very important to understand, in a very twisted way, bad news is actually good news. Bad news is good news. And if bad news is good news, I have plenty of good news for you today. Because we have to discuss this inflation. Exactly a year ago, everybody was talking about inflation. Remember? Inflation, 7%, 8% inflation. And back then it was very clear to me and others that it was never about inflation. It was always about the cost of bringing inflation down to 2%. Now, we can discuss until we are blue in the face to what extent 2%, which is the target, is the right number. I believe it's not. I believe it should be higher. We'll discuss why in a second. But it doesn't make any difference because the Bank of Canada is not going to change it. You need like 500 PhDs in dissertation to convince them to change it. Not going to happen. So we are stuck with 2%. So it's the cost of bringing inflation down to 2%. Because the Bank of Canada, the ECB in Europe, the Fed in the US, they have all established their reputation as inflation fighters. They are not going to toss it away. They will do whatever it takes to bring that inflation to 2%, even if it means taking this economy into a recession. This is a biased bank. You wake them up in the middle of the night and you ask, inflation or a recession? They will take a recession any day. And that's why they overshoot. I submit that every economic recession over the past 40 years, with the exception of COVID, was helped, if not caused, by monetary policy error in which central bankers raised interest rates way too much and killed the economy. Why? Because inflation is a lagging indicator. Inflation is telling you about the past, not the future. Inflation is like this brown spot on the banana. By the time you see it, it's way too late. So the point that I'm making here is that every economic recession was helped, if not caused, by a monetary policy error, including this slowdown. And we'll talk about this slowdown in a second. But first, we have to talk about this inflation. When you talk to people about inflation, the first thing they talk about is what? Food inflation. You go to the supermarket, we are all overwhelmed by how expensive food is. You basically have to mortgage your house to buy a cucumber or something. The Bank of Canada does not care. They don't care. Not because of the fact that they are not nice people, they are extremely nice people for central bankers, but because of the fact that it's irrelevant. Let's remind ourselves, you all know that, let's remind ourselves that inflation is a rate of change. Inflation is not the level of prices. And that rate of change, as you can see from this chart above me, is slowing down, which means that food inflation is actually disinflationary as far as the Bank of Canada is concerned. Disinflationary, despite the fact that it's extremely expensive. Then you have another issue, which is extremely important. Retail profit margins. Let's face it, during COVID, many retailers were hiding behind the fog of supply chain. Remember, you went to the store, you asked for this dishwasher, and they said, you know, China, India, supply chain. But if you pay a bit more, we'll find one for you in the basement. There was 97% correlation between supply chain movement, difficulties, and profit margins among retailers. Now supply chain is back to normal. Profit margins in terms of growth are approaching zero. A major underrated disinflationary force. Now I want you to look at the chart to the left. Look at the jump in profit margins. The question is, are they going to go down or are companies going to do something to maintain that profit margins? We'll discuss later in the presentation because it's extremely important. Remember that chart, we'll go back to it. And then we have something which is extremely important. Housing inflation, shelter inflation. Shelter inflation is 1/3 of the CPI, housing inflation. Now, what is shelter inflation? It's not the price of houses. Nothing to do with that. It's commissions to real estate agents, fine. It's rent that unfortunately is rising by 9% a year. We all know that. We all feel it. But the most important item is what? Mortgage interest payments that are now rising by 20% a year. Now, forget about economics. Common sense. Think about it for a second. The Bank of Canada is raising interest rates to fight inflation. Higher interest rates are adding to inflation through higher mortgage interest payments. That's crazy. It doesn't make any sense. It's like putting a humidifier and a dehumidifier in the same room and let them go at each other. It doesn't make any sense whatsoever. Nobody will be able to convince me that mortgage interest payments are inflationary. They are disinflationary. They are slowing down the economy. And, by the way, if you remove mortgage interest payments out of the calculations, inflation is already where? 1%. Below target. We are undershooting. And another important, by the way, the only other country in the universe that is using mortgage interest payments as part of their calculation is Iceland, a major economic superpower. Give me a break. If you measure it the way the US is doing it, we are at 1.2. We are below target already. Enough is enough. Cut. That's why I wanted them to go 75. We'll discuss later by how much they will go in the next meeting and how low it will go. Now, by now, I know that many of you are extremely disappointed because everybody promised you a recession and we didn't get one. Where is this recession? Let me tell you one thing. We are in a recession. We are in a per capita recession. Per capita GDP is down by 2.5%. Per capita consumption is approaching what we have seen in the 2008 recession, the Great Recession. Per capita, we are in a recession. There is no question about it. Per capita GDP has been going down for 5 quarters in a row. This is a real recession approaching what we have seen in 2008 on its way to 1991. So it is a recession. So the only reason why it's not a full-blown recession officially is because of the fact that we got 1.2 million people into this country over the course of breakfast. Look at this chart. Does it look normal to you? The OECD average population growth is about 0.91%. We are at 3.5%. This is madness. This is too fast. We simply don't have the capacity to deal with it. And to an extent, the housing market crisis is a planning crisis. Why? Look at this. Municipalities need time. It takes municipalities 10 years to plan for newcomers. You have to buy the land, you have to service the land, infrastructure, auction it, sell it. It takes 10 years. So each municipality needs a plan, a population growth plan. So 10 years ago, 2013, Stats Canada went to those municipalities and said population growth over the next 10 years will be X. In 2023, 10 years after, population growth was X plus 1.5 million people. That was a miss of 1.5 million people. So you cannot blame municipalities for not planning for something that was not in the plan. This is a failure of planning. This is a crisis of planning, not housing crisis. And the vast majority of the miss was non-permanent residents. Many of them were foreign students. Simply the government changed the rules without notifying municipalities, and the plan was not there, and that's why we are in a shortage. And that's why what we are seeing here is the government reacting now to it. And they're saying we have to cut the number of non-permanent residents in this country from 7% to 5%. This means that we have to basically reduce the number of non-permanent residents in this country by 870,000 people by 2027. It's not going to happen. We simply don't have the capacity. They are not going to deport people. We are not the US. I spoke to the immigration minister. We don't have the will, nor do we have the capacity to deport anybody. So nobody's going to be deported. That's not the US. That's not Trump. So what to do? You can see that even the Bank of Canada, the chart to the right, is not believing that the government will be able to achieve its target. Stats Canada is saying population growth is 1% next year, assuming that people will leave. Stats Canada is saying no. The Bank of Canada is saying no. We don't believe it's going to happen. 1.7. There is a conflict here between Stats Canada and the Bank of Canada in terms of population growth. But what counts for municipalities is Stats Canada. Therefore, this 1% number is actually going to create another shortage, because we are going to underestimate population growth again, repeating the same mistake. And the Bank of Canada does not believe in it. I don't believe in it. So what I think the government is going to do slowly, and that's extremely important from our perspective, is the following. Today we are getting 500,000 new immigrants from outside Canada. I think they will cut this number. They will cut this number. The only question is to what? 400, 300? I think it will be something like 400. So you have 100 to give. This 100 will come from the pool of non-permanent residents becoming permanent residents. So you keep the 500, but you change the distribution. So you will have more people coming to Canada from Canada, not from outside Canada, not representing new demand for housing because they're already living somewhere. That's, I think, going to happen very soon. I think the government will announce something about the number of new immigrants coming from outside Canada relative to non-permanent residents. So this is an elegant solution to deal with the 870,000 people that they have to reduce. How do you reduce it? You turn them into permanent citizens. I think that's what's going to happen. So that's more or less where we are. Let's talk about the housing market in general. Now, this all represents one thing. We all know that we are in a major housing affordability crisis. We all know that. The housing market is slowing down. There's no question about it. I'll just share some numbers with you in the condo space, because the housing market now is a tale of two markets. One is the low-rise segment of the market. The other is the high-rise. The low-rise segment is fine. It's not great, but fine. The condo market is in a recession. GTA, this is GTA numbers. Pre-construction condos sold down dramatically. Dramatically. If you look at under construction, going down dramatically. People are not building. If you look at the price correction, it's not in the new construction, it's in the resale market. Going down dramatically, will continue to go down because we have a lot of inventories. And we have a situation in which investors are out of the market. 81% of investors with mortgage are now with a major negative cash flow. They are out of the market. They are selling. And that's why the condo market is weak. And it will remain weak for the next year. So if you are in the market for a condo, this is your window. We haven't seen the condo market so weak since 1991. You want to buy a condo for the next year, year and a half. Otherwise, it will be too late. Why? Because we are building nothing now. Building nothing. Zero. Developers are not building. 2 years from now, the demand will be there. Interest rates will be low. Investors will be back. The supply that's supposed to come now to be ready 2 years from now will not be available. You don't have to be an economist to predict what will happen. Prices will go to the sky. You have a window of a year and a half to get into this buyer's market in the condo market before it turns around. That's more or less where we are. But this is just an adjustment. The big story is an affordability crisis story. We know that we simply don't have enough supply in the market. The adjustment that we are seeing now is just because of interest rates. It will go back to normal, and normal is not acceptable. We have a generation of Canadians, many of you are in this room, that can only dream about owning a house. Even rent is unaffordable. I had an opportunity to meet with the cabinet, the government, discussing the economy in general and housing affordability in particular. And I told them, this is a major crisis, and I'm not using this word lightly. If we don't deal with it urgently, we are going to have pockets of civil unrest. We are going to have anti-immigrant sentiments. We are going to have renters strike starting already. This is unsustainable. You cannot expect to see rent rising by 9-10% a year and people say, fine. No, it's not the case. We are in a full-blown affordability crisis, and it's an emergency. Treat this affordability crisis as COVID, because housing is a necessity. And the issue is that for many years, as you may know, we have been fighting supply issues using demand tools. Enough is enough. For the first time, I meet with governments on a daily basis, at all levels. And I believe that they are starting to realize that. Just because of the fact that they realize that the next elections, regardless where you are, will be all about housing. So they are panicking. And part of the solution is going to be a rental solution. We need to create a situation in Canada in which you are 35 years old, you are married, you have 2 kids, and you are renting. Nothing is wrong with you. The way it is in Berlin, the way it is in London, the way it is in Manhattan. We need to have a rental solution. And this rental solution cannot be the condo market. The condo market cannot be the rental market, and the rental market cannot be the condo market. It has to be purpose-built rental, apartment buildings. The next wave of renters will be young families with kids. They need security. They need to know that everything is okay, and they can send their kids to school without a landlord telling them that they have to leave. That's the new wave of renters. For this, we need purpose-built, and for this, we need incentives. I meet with the city, with the province, with the Ottawa all the time, and we say we need incentives. We need to reduce development charges significantly, eliminate them, especially over the next 2 years because nobody's building. We need to eliminate property taxes, and the money is there. The province has the money, the city has the money, and clearly Ottawa has the money. This is a crisis. Treat it as a crisis. So that's one way of looking at it, and that's something that we have to deal with. Another thing that we have to do is make sure that there is no rent control. Rent control is coming from a good place, but it's very wrong. I always quote a Swedish economist that said, rent control is the best way to destroy a city, maybe besides bombing. If you introduce rent control, you kill supply. And supply is the only affordability tool that I know. Another thing that we have to do very quickly, because we don't have much time, is we have to change the way we build. Take a pilot from 50 years ago, put them in an airplane today. They will be totally confused. All those buttons, they don't know what to do. Take a construction worker from 50 years ago, put them in a site today, no issue whatsoever, because we build exactly the same way. We have to increase productivity. No surprise that productivity is lagging dramatically when it comes to construction. The overall economy is nothing to start to write home about. So we need to build differently, including factory-made housing, which I believe is going to be the solution, and it's going to be the future. Sweden, 80% of their houses are basically factory-made, 3D printed. It can be done, and it's going to cut the cost, and the speed in a very significant way. So that's the housing market. Very quickly, you are the Bank of Canada. You cut interest rates by 50 basis points today, wonderful. You have to do more. Why? Because we have to realize that interest rates are still way too high given where the economy is. We are in a per capita recession. The condo market is in a recession. The housing market is slowing. Everything is slowing. Inflation is not an issue anymore. Cut it. There is a concept of neutral interest rate. It's about 2.5, 2.25. We are at 3.75. So we are still tightening. You have to start cutting and cut fast. I said the next move should be 75 basis points, although it will not be. It will be 50. So how low are you going? Well, it depends on one thing, on the US. Why the US? Because until a month ago, the US was very strong. We had a situation in which the US was surprising on the upside, and the Canadian labor market was slowing down. As you know, every first Friday of the month, at 8:30 in the morning, we get the employment numbers from South Canada. 8:30 in the morning, first Friday of the month. So at 8:29 in the morning, every economist is sitting in front of his computer, looking, waiting, anticipating the numbers. Believe me, it's very exciting. And every time we look at the unemployment rate at any point in time is two things: the probability of becoming unemployed and the probability of staying unemployed. Both of them are rising, which means it's sustainable. And it's broadly based. It's new immigrants, it's older people, younger people. It's broadly based. Wages are not rising anymore. The bargaining power of labor is down. Remember, bad news is good news. And that's exactly what we are seeing now. That's exactly what the Bank of Canada would like to see when they raise interest rates. They need to see the labor market slowing down, and that's exactly what's happening. So why not cut even more? Well, first of all, you have to see what's happening in the US. Until a month ago, the US was very strong. Inflation was higher than expected. People say, forget about the recession in the US. Forget about soft landing. No landing in the US. And then something wonderful happened. They started to slow down. Why it's important? Because the question is how much the Bank of Canada can divorce itself from the Fed. Remember, many of you study economics. If you cut interest rates in Canada and the Fed does not cut, what happens to the value of the Canadian dollar? It goes down, which is by itself inflationary. So we have a situation in which the Fed was saying we are not cutting, and the Bank of Canada was in the middle of cutting. How much can you divorce yourself from the Fed? The last time it happened was the opposite. Mark Carney raised interest rates to the sky while the Fed was actually cutting. The Canadian dollar went to parity, as many of you remember. Florida was extremely cheap, but we lost 15% capacity in manufacturing. What kind of legacy is that? That was a mistake. And it will be a mistake to divorce ourselves from the Fed now with taking the Canadian dollar lower. And that's why it was good news that the US started to slow down and the Fed actually cut by 50 basis points, which means that the Fed is cutting now. The Bank of Canada has the green light to cut because the US is actually slowing. You can see that without the consumer, the US was already in a recession. So the consumer was carrying this economy. Why? Because of this. This is COVID. During COVID, many people got their salaries, they got money from the government, but they didn't spend any money. We accumulated what we call excess savings of $350 billion in Canada, $2 trillion in the US. Excess savings beyond normal. So think about it for a second. The Fed, the Bank of Canada were raising interest rates. We had this extra money and we spent it. We went to restaurants, we traveled, we went to hotels. So we neutralized the Fed and the Bank of Canada by using this money. Now, this excess savings is what now? Zero. We spend all the money, which means that the buffer is no longer there. When the Fed and the Bank of Canada were raising interest rates, we felt the pain immediately because we have nothing to protect us, and that's exactly why the economy is slowing down. The labor market, the probability of exiting unemployment is falling. The probability of getting a job is falling. Clearly, the labor market is slowing. It's not weak, it's weakening. Again, a reason for the Fed to cut. And remember, interest rates are still extremely high. This is adjusted for inflation. If you look at the level of interest rates adjusted to inflation, real interest rates, they are at a level that in the past led to a recession. Cut, cut, cut. Enough is enough. Inflation is no longer an issue, and you are basically in a recession with the consumer not protecting you anymore. You have to cut. And when you cut, if some of you are investing, look at this. When interest rates were rising, everybody went to GICs. Forget about stocks, forget about bonds, GICs, 5-6% GICs. Now we are cutting. I estimate that we have $370 billion of excess money sitting in GICs now, looking for direction, looking for the exit. This money will go to dividend-paying stocks in the stock market. Therefore, I'm longing dividend-paying stocks now because we haven't seen something like that. $370 billion in Canada looking for exit, looking for the exit, looking for direction, and this direction will be high-quality dividend-paying stocks. So you are the Bank of Canada, what do? Well, you cut. By how much? We started this saga at 175. We went to 5. We are at 375 now. How low? I say 225, 2.5. So much lower than it is now by the mid or end of 2025. But much higher than it was before. Why? Because think about it for a second. Whenever you think about the economy, whenever you think about where we are in the cycle, ask yourself the following question. To what extent COVID was an event or a condition? I believe that COVID, economically speaking, was a condition. We used to have globalization. Now we have deglobalization. We used to have just-in-time inventories. Now we have just-in-case inventories. We used to have a labor market that was giving. Wages were going down. Now the labor market is tight, demographically speaking. And now we have those green initiatives. All of them are doing one thing. They are putting upward pressure on inflation. Now remember, the target is 2%. So the target is the same. The background is more inflationary. Therefore, the ultimate neutral rate should be higher than it used to be. And that's exactly why I believe that the new interest rate will be higher than it used to be, including long-term interest rates. And that's the new normal, and that's a good thing, because if there was something that was mispriced over the past 50 years, it was cash. So going back to 2.5% is normal, it's good, it's healthy, including the housing market. But of course, I cannot conclude without talking about Trump. I don't know who's going to win the elections in the US. No idea. But what I do know that in both cases, that the budget deficit will rise. If Harris wins, the budget deficit will grow by $1.7 trillion. It's already 8% of GDP. If Trump wins, it will go even more than that because it's going to cut taxes significantly. But the most significant issue with Trump is trade. You want to understand what Trump thinks about trade, there is a book out there. It's called No Such Thing as Free Trade. It's written by Rob Lighthizer, who was the trade representative of Trump back then. 60% tariff on China, 20% tariff on the rest, including Canada. I say he will bark, but he will not bite. Why? First of all, those jobs are not coming back. Manufacturing jobs went down before NAFTA, after NAFTA, before China entered the WTO, and after China entered the WTO. before Trump, during Trump, and after Trump, and during Biden. Clearly, it's not about trade, it's about technology. But tariffs do work. Look at this. This is extremely important because it's coming. When Trump introduced tariffs in 2017-18 on China, look at the exports from China to the US, the black line, went down dramatically. But what happened is something interesting. Other countries were gaining that lost market share. Those countries, including South Korea, Vietnam, India, Mexico, Indonesia, Malaysia, they gained significant market share at the expense of China, which means the tariffs do work. Now, if you are China, you're not stupid. You see what's happening and you say, I want to be part of it. How do I enter the US market through the back door? I invest in those countries. So if you look at China's export and direct investment to those countries like Mexico, India, Malaysia, South Korea, Vietnam, going to the sky. So this is a way to get into the US through the back door. It's like a trade policy by proxies. And I say, this is not going to work. Why? Because China is not the target anymore. All those other countries are the target. So all of a sudden, you have to go after China and all those emerging markets. And you cannot do that if you're Trump. Why? Because 1/3 of your exports are going to those countries. This is the emerging market consumer, the fastest growing segment in the universe. If you start a trade war with them and they will retaliate, you lose access to the fastest growing segment of the global economy. Your manufacturing sector will suffer dramatically, your base. And therefore, I believe it will bark, but it will not bite, because it simply cannot do that. The way it was with NAFTA. NAFTA 1 is exactly like NAFTA 2, and NAFTA 2 is exactly like NAFTA 1, despite all the noise. So that's the way I see the situation, although I really don't know who's going to win. So to sum up, we are in a per capita recession. The Bank of Canada, as usual, overshot because it's a biased bank. Interest rates will continue to go down from 3.75 to 2.5 to 25. That will be the new normal, which is going to be a higher level than it was before. COVID was a condition, not an event. And clearly, what was normal in the past is not normal in the context of today's economy. Okay? Thank you very much for your attention. And if you have any questions, any comments, if you think I'm totally out to lunch, let's have a conversation and don't be shy. Yeah, I'm waiting. Yes.
We have a couple of mics.
Okay.
One over there with Paul, and I'll be moving my mic around. But I wanted to just start things off by asking you, you meet with and speak to the Bank of Canada on a regular basis. Maybe even once a day, you were mentioning to me at one point. Can you give us a little insight into what those conversations are like? What are the questions that they're asking you, and what is the information that you're trying to get through to them?
Yes, I think that they try to understand what we think. They look at financial institutions because what's happening with financial institutions in terms of credit is very important to them. So they want to see if credit growth is slowing down, if people are more risk averse. So they look at our books and we tell them, okay, we see some softening in this and this and this. So that gives them an indication of what's happening, and that's important. That's important. So we give them information from the bank to lead them to the way to think. They are listening to what we say in terms of our advice, what to do, what not to do. But of course, they have to make their own decision. It's not an easy thing to do because I can stand there and say they are wrong. But when you have to make a decision, your hand kind of shake. So they don't take chances. They are very conservative. And that's, I think, a good thing. That's a good thing. But I wrote a piece the other day. I said, what if the Bank of Canada was an AI machine? They didn't like this title in Autobabadi. But I said an AI machine will have stopped raising interest rates much longer, much faster or sooner than the Bank of Canada. And I think they know that. More questions?
Ben, one more question. You you mentioned the U.S. election and, spoke to, Trump and Biden and so on and so forth. There will be at some point an election in Canada, a federal election. What, if any, difference will it make if there is a change in government to the economy, to the housing sector, and so on?
Yes, that's a good question. First of all, I think that we might see the elections in Ontario before in Ottawa, but we'll see. The surprise will be if the Conservative win, and I think at this point that's what might happen. What might happen. The difference will not be very significant in a very short period of time, like in the first year. When it comes to the capital gain tax, I don't think that the Conservative will kill it. I think that the housing policies will be more or less the same because they are basically saying the same thing. I think that the tax aspect, they will wait with that. So I think that it will be more fiscally conservative. The main impact will be on the environment, the main impact will be on energy, but the surprise will be how little the difference is. More questions? Yes.
Yeah, so I just had a question with the rest of the world and China, how you showed that exported demand for goods has gone higher throughout the years, and China has gone down throughout the years. What would you say? What would you say? Like, how much do tariffs like how much do tariffs have a role in like the exported goods, because they do, like, don't they add to the economy?
Yeah,
To like the rest of the world and China?
absolutely. There is a chart here that I didn't show you that shows that the higher the tariff is, the more significant the decline is. So it's really all about tariff. It's all about tariff. It has been very significant, and if Trump is going to introduce it, it's going to be even higher, and it will be more effective. And that's why it's going to go to the substitution effect that we have seen. Absolutely.
Hi. Following Credit Suisse and the Silicon Valley Bank collapse in 2023, with SVB facing a ton of unrealized losses, what are like some regulatory changes that would help banks better manage liquidity risks?
Yes, I think that it's already in the pipelines. I think that one thing that is going to be different between the Trump administration and Harris is regulations. I think they will regulate financial institutions much more, Harris. Under Trump, it will be much less. And that's why I think that if Trump wins, I see stocks in banks and financial institutions actually rising, but the risk level also will be rising.
Mr. Tal, I had a question.
Where are you?
Here. You mentioned that rent control is a bad thing for most of the time, and that Europeans love it, and that rent control kind of kills the supply. Could you elaborate on that?
Yes, I think that rent control is a very dangerous thing. First of all, I understand where it's coming from. I think it's a wonderful thing to care about rent control, but the only affordable solution is more supply. Why? Because if you have rent control, you basically subsidize current tenant at the expense of future tenant. Because nobody will be building anything under rent control because you cannot make money out of it. So there will not be any supply. In some countries that have rent control, you have to wait 8-9 years for an apartment. And then when you get it, all your families and friends throw a party. Like, we don't want this kind of situation. We need more supply. The supply will come only if you tell developers there's no rent control. The only rent control that I know that is effective is supply. And we have to increase supply dramatically, and we have to do whatever we can. Yes.
Hello, thank you very much. So going back to that issue on housing and rent control, I mean, it's estimated that I do understand that part of the problem is issue with supply in terms of housing. However, it's estimated that about 50% of rental units are owned by foreign investors, especially in Toronto. So how does that play into the fact that that's also a part of the problem in terms of, I remember Stephen Harper's Conservatives, like the Conservative government, part of their agenda was getting foreign investment. And I find that nobody seems to speak to that issue of how foreign investment has also drawn up the housing price.
Okay, so first of all, the 50% number that you quoted is for investors, not foreign investors. The investors is much smaller than that. It's actually 8-7%. So I don't think that the foreign investor story is a major factor at all. I think it's a good thing to tax them. I think that's fine. In some pockets in Vancouver, they dominate the market, like Richmond or something like that. But the 50% that you're quoting is actually investors. Most of them are domestic. That's the issue.
Hey, Benjamin, thank you so much for being here today. I had a question regarding something that you touched on of all the demand stimulus versus supply stimulus that's added to the housing market. The new mortgage reforms coming in December. That is obviously a demand push more than solving housing affordability from a supply perspective. So what are some things that you think might negatively affect with that demand push, and your own thoughts on ways to better housing supply?
Yeah, that's a very good question. So yes, what the government just did recently about the demand aspect is politically motivated, and I totally understand that. First-time buyers are struggling. The 1 million cap was irrelevant given where prices are. So it makes sense to an extent. The amortization, I'm not so sure that it's the right thing to do, but it's not a big deal one way or another. The main focus should be on, I agree, on supply. And here it must be a rental supply. It has to be factory-made housing. I'll give you an example, something that I wrote yesterday and I released it yesterday. Developers are sitting on huge amount of land that they're not using. And they will sit on this land for 10, 15 years before they do something. So this land is sitting doing nothing. I say, what if you lease this land to a non-profit or to a municipality, and they can build factory-made housing on this for 5 to 10 years, rent them out to refugees, to non-permanent residents, to students, foreign students, and then disassemble it 10 years after, and you can reuse it for other things. Then you have productive land. That's why productivity in construction will rise, because you use the land and not collecting dust. So that's an example of thinking differently about utilizing our resources. I think we have to look at a rental solution, but it has to be purpose-built rental. And I'm all for incentives to provide to developers to decide, not condo, the purpose-built. And we fought the HST. We were fighting it very badly, and we won this fight. HST, GST removal. There is another thing that we are fighting now, and we might get it. It's called 1031 exchange. 1031 exchange is the treatment of capital gain in commercial real estate. In the US, there is something called 1031 exchange, in which you sell a property, you get the money, your profit, you invest it in another property, you don't pay tax. In Canada, you pay tax immediately. If we introduce the same treatment in Canada, it will create momentum. So there are things to do.
Thank you. And thank you for those suggestions. I really like those strategies that you're coming up with. So I'm a bit biased because I'm faculty here and I teach environmental law. So I'm interested in what mechanisms you would think about in regards to climate change and the economy. What legal remedies or market mechanisms should be used to manage climate change in the future?
Yeah, I think that we're
Backs up
starting
the
to do the
economy.
right things. We are moving slowly, but I think that at this point you reach a point in which if you don't do it, you're going to penalize by the market. It used to be seen as a cost. Now I believe it's actually a cost of not doing it. And therefore that's a positive. I think the way we build is all about that, I think. We have to change the way we build. There is a company in Canada, Front Street. It's called R Labs. It's a startup company. It's actually an umbrella for startup in real estate. Most of them specializing in environmental building. They come up with all kinds of extremely good ideas. We need innovation in order to improve our ability. And this kind of umbrella companies, it's called R Labs. Write it down, visit them. It's fascinating what they're doing. That's the future.
Hi. You mentioned before the plan to turn non-permanent residents into permanent residents. I was wondering if you could elaborate on that.
Yes, I think that what we're having now is like the quota is 500,000 people entering Canada from outside every year. Now we have an army of non-permanent residents that are now without a visa or expired visa. So what to do? We are not going to expel them, of course. So what you can do, you can reduce this number and move it to this number. So reduce the number of people coming from outside Canada to, let's say, 400,000, and add 100,000 people from inside Canada. That's the idea.
Hi, sir. Thank you so much for your time. Just had a quick question with regards to your thoughts on the condominium crisis. You said that there are supply issues that are now being solved by demand tools. Wanted to maybe get a little more insight into that, if you could elaborate a little bit further.
Yes, so the condo space, it's a question of where you are in the cycle. In the next 2 years, I think prices in the resale market, will continue to go down. Because I think that we have a lot of inventories, investors that you mentioned are out of the market already. They're actually selling. So we have a lot of inventories, something that we haven't seen since 1991. So you have to clear the market. So it's a buyer's market. So I believe that over the next 6, 12 months, whatever the number is, you will see a situation in which prices will go down. One of the reasons, by the way, that the Bank of Canada would like to go slowly with interest rates, and they said it today actually, is because they are fearful that the housing market will recover too fast. We all know that you can never underestimate how strong this housing market is. So the minute interest rates go down quickly, this housing market will go up, and the period of the window in which you have a buyer's market in the condo space will shorten. So we have a window here, and I cannot tell you how long this window depends on how quickly interest rates will be going, and then it will not be having any supply because we're building nothing now, and that's my worry.
How's it going? My name's Jaden. It's nice to meet you. I'm glad you could come out today. So I just had a question. Throughout your experiences and the adversities you will overcome, if you were able to go back and tell your younger self one thing to possibly either guide you or just kind of help you build a structured path to kind of follow, what would it be?
Yeah, that's a tough one. So a few things I would say. First of all, don't compromise. Do what you like to do. In the short term, every job looks good. But if you feel that you go to work and you say, I'm not interested, drop that job and look for something else. If you want to be successful, you must do what you love. I know that it's a cliche, but it's extremely important. One thing. Second, take the more difficult courses. Really. Don't take easy courses. Take difficult courses. Because that's the one that will distinguish. You can graduate from economics or business, but if you took the easy one and you can take the easy one, it will not impress a future employer. And use technology. When they say AI will take your job, the person that uses AI correctly will take your job, not AI. That's my advice.
Hello. My question is about employment. If the manufacturing jobs are not coming back, how do we create more jobs for everyone? For newcomers, for young people, for older people?
Yeah, so how do we create more jobs? I think that what we are seeing now, I'll tell you where we are in the cycle. Remember all those conditions that I mentioned? Just-in-time inventories, deglobalization, the labor market, and green. They are putting upward pressure on inflation, but they're also doing something else. They're putting downward pressure on profit margins. Think about it. Globalization was good for profit. Just-in-time was good for profit. Now all those forces are putting downward pressure on profit. I believe that over the past 30 years, profit was easy. There was no motivation to invest because profit was easy. Now profit is difficult. So you are a CEO of a company. You have two options. One is do nothing. The other is do something. And this something will be to replace labor with capital, which is productivity. That's exactly what happened during the dot-com revolution. Companies will replace labor with capital because labor is more expensive now and capital is becoming cheaper, and you have no choice. You have to invest. You replace labor with capital, which means there will be, and the AI revolution, by the way, is positioned perfectly to take advantage of this trend. In 1996, the dot-com revolution in the 90s, we have seen productivity rising to the sky. Wages went up, but it was not inflationary. If I give you a 10% increase in your wage and you're 10% more productive, that's not inflationary. That's exactly what's going to happen over the next 10 years. I'm very positive about productivity in Canada. Unfortunately, it means that there will be winners and losers. And the losers will be people who are not part of this technology wave. And that's where the government will have to enter. That's why what you do is so important. What you study is so important. Let me tell you one thing, one statistics. Maybe it will encourage you. Canada is the most educated country in the OECD. in terms of the number of people going to universities. The most educated country. But we are also the number one country in terms of the number of educated people that live in poverty. Because we cannot translate those degrees into jobs. We need to be relevant. Take the difficult courses. Challenge yourself, and you will be part of this revolution.
Hi, Benjamin. Thank you so much for all the insights today. Over your talk, you mentioned that one of the best remedies to the housing crisis is an injection of new supply into the market. However, one of the biggest challenges with pushing through new developments is municipal fees and the fact that a lot of times you have to negotiate for 2+ years to push a new development through. What do you have to say about these current challenges, and do you see any potential solutions to it?
You are absolutely right. One of the major issues is taxes given to municipalities and other governments, and clearly the time that it takes, the red tape. Absolutely right, and that's very frustrating. We have to change it. We have to make sure that it's changing. We put a lot of pressure on governments to simplify. They are getting it for the first time. It's still not moving fast enough, but that's absolutely right. Absolutely right. This is a major issue that we are fighting on a daily basis. Remove the red tape. Do things much more simply. And it's moving slowly, unfortunately, but you have a good point.
Hey, Benjamin, thank you so much for the talk. You mentioned about $370 billion outflow from GIC to stocks. If you go back to the chart, it is in tandem with a lot of students coming into the country where the government had placed a compulsion for them to hold $20,000 in a GIC account and for a span of between 1 to 2 years. As these students are completing that 2 years, they are sending all the money back to their home country, or even the Canadian investors who had put their faith in GIC, if they are taking it out, they are at an affordability crisis. So instead of taking it out and putting it in stocks, a lot of investors are actually putting it for either expenditures or just housing. So what do you think will happen to this void of money that will just leave Canada and not enter the stock?
Yeah, that's a good question. That's a good point. We did some focus groups. We look at clients, and unfortunately, that's the way it works. The people with the money are not the people with the debt. So the people with the $370 billion are people with money, and they will be investing. So most of this money will go to the stock market, to the dividend-paying stocks. It's not going to pay mortgages. That's not where the distribution is. And that's very unfortunate. That tells us a lot about our society, something that I'm very concerned about. And that's why education is so important. The income gap, the wealth gap.
Hi, Benjamin. So a quick question. So you mentioned about the imbalance between the supply and demand for the residential market. What about the commercial real estate market?
Yeah, commercial is very tricky. It depends where in commercial. If you are in the industrial commercial, you're fine. Although rent is extremely expensive and slowing down, there's simply not enough supply and the demand is going there. If you have just in case inventories, which means that you need more supply of industrial real estate. When it comes to office, very challenging. I think that in the office stories, the difference between Class A and Class B. Class B will be struggling big time. Class A will do fine. Retail, high quality will do fine. Low quality is dead. So it really depends where you are in the commercial real estate. Okay, thank you very much. Good luck.